Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending June 11th, 2021. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is, has inflation peaked or do we have higher to go? What's going on with it? It seems like the markets are a bit confused on one side, or at least a number of traders are. But before we get into that, let's just kind of take a look at where we've been this past week and just kind of lead up to what's going on here. So let's take a look at the index performance here. You can see that pretty much everybody was in the green for the week except for the Dow. We had a very strong week with the Russell, which is a risk-on trade, up 1.93% for the week. Year to date, it's a whopping 18.01% in the green. Both the Dow and the S&P are in the green, 12.9, 12.6%. NASDAQ is catching up just a little bit. NASDAQ had a good week as well. You can see the best sectors for the week were healthcare, worst was materials, and then annual performance, energy still leading the way as it has all year. Staples is bringing up the rear, both in the green, but energy is just very strong this year. You can also see the PE ratio. The forward PE, which is kind of where we want to focus on, is 22.47. So the markets are still very rich, as we would expect with very low interest rates in the market. A lot of stimulus out there. The dividend yield for the S&P kind of hanging in, same as it was last Friday. It's closed. It came in at 1.3%, 1.36%. 10-year Treasury dropped down to 1.46%. So the spread now is only 10 basis points between Treasury and dividend yield. So the spread actually fell 10 basis points for the week, right? That continues to push money into the equity markets. Current VIX down 6.6% for the week. It closed out the week at 15.65. We haven't seen it that low in a while. I'll talk about volatility in a minute as well. So, this week, if we just take a look at it, and let's look at the economic data and just kind of how that kind of paired its way out there. We saw yields briefly jump, but we've got the CPI data on Thursday. The Labor Department reported that core inflation rose 70 basis points in May, but basically 5% year over year. Really amazing. We did see the survey, consumer sentiment, also showed that going up as well. And you would think with all of that, interest rates would have gone higher with higher year over year inflation, over 5%. But interest rates actually came back down. In fact, they kind of worked their way down all week. And looking at the U.S. Treasuries, they continue really to dominate overall market sentiment. I mean, the yield on the benchmark 10-year, as I said, decreased most of this week, actually being pushed lower by recent assurances, by the Feds, that they're going to keep monetary policy very highly accommodative to the markets. And there's this group of folks. If you watch any business show on TV, you've got one side of the table saying that inflation is transitory, it's going to come back down. You got another side that's saying this inflation is going to stay and we're going to have hyperinflation the next year or two. In fact, if you read the report from Deutsche Bank, they're talking potential for hyperinflation coming in the next year or so. And then you read reports from Goldman and a few others that inflation is transitory, commodity prices are going to start to come back down as supply chains open up, and we're going to see inflation come back down. Well, typically the smart money is considered debt money, treasuries. And if we just take a look at the 10-year treasuries, which is kind of the benchmark treasury yield worldwide, it has been coming back down. So that would tend to show two things. One, we can expect a little bit slower growth in the future, which I would also support, but that they believe inflation is transitory as well. Now, I look at it in a little bit more with bifocals on. I think both sides are right. I think inflation is a little bit elevated right now. It will come down a little bit as supply chains open, but there's certain segments that make up inflation that are going to be sticky and hard to reduce, primarily labor rates or wages. Once you start paying people higher wages, it's going to be very hard to say, okay, well, we were paying you, $18 an hour to get you in here, but now we're going to drop it down to 15. It doesn't work that way. So there's going to be certain sticking points with price pressure that's going to be there. So the big issue with the Feds, and again, we're going to see them meet shortly. That would be next week. And we get Boom Boom Powell and we get his press conference. Everybody's going to be listening to him and how he defines transitory. Right. The last time he did that, for those of you that remember, was in December of 2018. And he used the word transitory and he made a mistake and the markets fell. The Dow, I remember, was down, a couple thousand points. S&P was down huge until he came out and said, okay, my mistake. And he was, in fact, the mistake that he made back then was talking about raising the rates too fast. So now this is just the opposite of what he did in December of 2018 going into 2019. And I remember that moment. So I think sitting in the back of his mind, he's sitting there going, okay, well, last time I did this, I raised rates too quickly. This time I'm going to err on the other side. We're going to use jobless numbers. Once they come down more, I don't mind inflation running hot. So he's making a big gamble with the markets. Markets are kind of getting a little bit complacent right now. I'll show you that in the charts. But he is making a gamble. I do believe personally, what I believe, it's like an 8 ball. Shake the 8 ball and see what it says. But I do believe that they're going to set the stage at this press conference to start thinking about tapering. They won't cut or raise rates. What they'll do is start cutting the stimulus. They're spending 120 billion a month. So they're probably going to slowly phase that out like he did before when he started raising rates in 17 going into 18. So I think what he's going to do this time is the same thing. But then when they're going to start to announce it is at the Jackson Hole, Wyoming muckety muck meeting. That's when all the central bankers worldwide get together in Jackson Hole, Wyoming, the middle of August. They typically use that as the date and opportunity to make major changes in policy. And I think that's when Boom Boom Powell, that would be Jerome Power Ranger Boom Boom Powell, steps up to the podium in Jackson Hole, Wyoming, and says, we're looking at cutting rates. We're going to start that shortly. And then in the very next Fed meeting in September, he's probably going to say, or the Feds are going to say, starting in December or January of the following year, we're going to start cutting the monthly QE. Now, every time they've done that, the markets pull back. Right? I've been on record as saying that we should get anywhere from a 7 to a 12% pullback sometime in June, July, August timeframe. Well, we're, first week and a half in June. So we've got, another 60 days, 80 days to go for my time frame. Now, for those of you that listen to me every weekend, thank you, first of all. But second, that I called the same thing last summer. I was calling for a pullback in July, August. We got the actual pullback in September. And it was a 10% pullback, kind of a scare of the children moment, and we kind of got out of it. This is going to be very similar to that. It's going to be a scare of the children moment. And then I think you're going to see the buy crowd come back in, the buy the dip crowd, more big money. And they're going to come in and they're going to pick this thing back up again. I think the bigger pullback, which is going to convert into a bear market, is not going to happen until 2022, 2023. So that's just at a macro level, kind of what I'm looking at. Okay. So that, I think, next week is going to be very closely monitored, the FOMC. Remember, they meet Tuesday and Wednesday, and then they have their press conference Wednesday at 2:30 p.m. Eastern Standard Time here in the United States. So all the markets are going to be focused on that. Now, of course, if we look at Europe and see how they did, you'll see pretty much in the green all around. The stocks, the FTSE, the London Index, CAC 40, the French, DAX, the German. German was flat. They're all in the green. Everybody's very strong. The Euro stocks, which was leading the way worldwide, is now down to 16.16%. You'll see the CAC 40, it's still leading worldwide, 18.9%, the French index. Everybody's solid in the green. And look at the Asian markets. Japan was just slightly above break even, but China and Hang Seng bringing up the rear for the week. Year to date, China's the one that's having the harder go of it, primarily because they've already been cutting back on their stimulus. They've got the long-term view, which is kind of what we should be adapting here. But politicians in the U.S. are mostly idiots, and they're going to basically just kind of put out there what the little kids like, which is more chocolate, more blueberry pie. Okay, although Janet Aunt B. Yellen came out and she did say, I think the U.S. economy could do better with higher interest rates, higher inflation. So I don't know what she's smoking. She's probably eating too many of her blueberry pies, but that's kind of what she said. So she's prepping the way for interest rate hikes and for stimulus cuts. I can see it coming. I can feel it because inflation is not something you want to screw with. And once it gets really out of control, the only way to bring it back into control is put the U.S. into a recession. It's the only way. And how would they do that? They would do that by raising the rates. So that's what's going on over there. And the Eurozone, we're seeing all the bond yields fall there too. So that does show slower growth going forward, but it also shows that they're buying into the transitory effects of inflation because, like the US, inflation is higher across Europe also. Now, the ECB did have their policy statement this past week. They expect the inflation in 2021 to come in near 2%, okay? And they revised their forecast for inflation to slow in 2022 and 2023 down to 1.4. So they do see it pulling back. But with all that stimulus out there, even if inflation is pulling back, the central banks are going to have to stop this stimulus and start pulling money out of the markets, reducing balance sheets. And I promise you that's going to cause a reaction in the markets. Number one, PE ratios won't be this elevated. You know, in the U.S., the forward PE, as you can see on the screen there, is 22.47. When interest rates start going higher, that's going to come down, guaranteed. That's just the nature of math and how this stuff works. But we're going to get strong growth. We're going to get strong growth in Q2 earnings, at least they're forecasted that way. For members this Sunday evening, we're going to go into that a little bit more detail, but a special bonus for our members this Sunday evening. I'm going to do an option masters as well. Sunday evening, we're going to talk about the strategy that I've mentioned to you guys in our chat room, which allows you to make money on a high flyer, but should it reverse and go down, we're not going to lose money on the trade, right? And it allows you to play high end and take advantage of high premium in the options for those stocks that have high volatility. They're great to trade. We got a great strategy on for it. In fact, we're running one now in our secret trader, and we're making money on it. So I'm going to go into much more detail on it for you guys, for our members, because I put that new trade strategy out there, and I want to go into more detail on it. If you're not a member, highly encourage you to come in and join us because just one strategy like that over a 4 or 5 month period will pay for our membership easy. But anyway, members, that'll be something we'll be doing tomorrow evening. But going back to the European markets, you can see the Eurozone economy is expected to grow 4.6% this year. Next year, 4.7%. So they're getting pretty aggressive in their growth. So they're, again, just like the U.S., they're going to have to cut stimulus. And we'll see a market reaction to that. And then, of course, if we look at China, their state media reported that both the U.S. and China agreed to renew talks on improving trade and investment ties. So we'll see how that shakes itself out, with our current administration, which is, running around in circles, but either way. And then we do see in the Chinese bond market, the yields there, unlike here, have been gradually moving higher, right? So we're getting that pullback in the Chinese markets. They were almost in a bear market a couple of months ago, about a month or so ago. And now they're in the green, but just barely, right? And their yields are going higher, just the opposite of here in Europe, because they're about 60 days ahead of us as far as the pandemic and all the results. Folks, we can expect that here too, right? That's just kind of what I'm seeing. Now let me switch you over to the charts here. Let me just get this flipped over here, and we'll go take a look at the E-mini S&P 500 futures first, and then we're going to shift and look at a couple of other things here. So I'm going to wait for this to come up on the screen, but what you're going to see is the E-mini S&P 500 futures, and you're going to see that we made a higher high here on Thursday. We actually moved up to 42.49, almost 42.50, right? Now, if you guys recall, about a couple of months ago, 3 months ago, I was saying we're going to run up to 41 to 4,300, and this is when we were at 3,800. I said that'll happen. That'll be the highs for the year, but sandwiched in between that is going to be a 7 to 12% pullback. And that's just kind of what I'm seeing on the charts. That doesn't mean it's going to happen, but generally around 60% chance, 63% chance that that's kind of what the charts are saying. If you look at the MACD, we got the divergence in the MACD. You can see the 50 moving average, the red line here, where it finds support in price action. This dip that we're going to get is going to take us below the 50 EMA. We'll probably test the lows that we made here in early May, middle of May, right? This first dip here was when the CPI came in hot. Came in at 4.2%, and it surprised the markets, and then away we went. All right, interest rates went higher, markets went lower. That's what you would normally expect. And then this week, CPI came in at 5%, not 4.2. It came in even higher, yet the markets yawned it off because the Feds, basically reiterated the transitory theme. Interest rates kind of pull back a little bit, confuse a lot of people. But I think the next pullback is going to be a little bit more significant than the one that we experienced in May. We'll probably test the 50 EMA, but if I map it out and just kind of show you here, I can take you down. There's a lot of support down in this area, and somewhere right around that support, you can see it's around 11 or 12% pullback. All right, and by the way, this is a key fib node here at 23.6%. And it would put us at 37.50. So I would not be surprised to have a little scare the children moment. VIX goes back up into the high 20s or low 30s, and we find ourselves somewhere down here over the next 90 days, right? Over the summer months before we get through middle of September. But let's say towards the end of August, I can see that happening. Remember, if the Feds come out at the Jackson Hole, Wyoming conference in the middle of August and say that we're going to look at cutting stimulus, we could have the S&P move 200 or 300 points very quickly. In fact, just on that hot CPI number, the S&P moved 218 points in 3.5 days. Right, these are day bars, but in 3 days it moved about 200 points from almost the highs down here to about 40.50 down to 40.20. Right, from 42.30 from that prior high point right there. So over 200 points in 3 days. So, and that was with a high print on CPI. We had a higher print this Thursday, and like I said, markets didn't do anything because they were prepped for it, I believe. But if the Feds talk about cutting stimulus, then 200 points is nothing. We could hit that in actually 1 day. I wouldn't believe it. I'd probably 100 point down, and then 3 days later we're 300 points down. Then we attempt to rally, it fails. Next thing you know, we're 7 to 10% down. That's kind of how I see it's going to play itself out. Now, it will be a buy the dip. Big money is going to come back in somewhere down in this area down here, pick it up. You can see the 200 EMA, which is this yellow line, is sitting right at 37.80. So at 3,800, test the 200 EMA rather than the 50 EMA. We will get a test of it. It's just a matter of when. And that test, just to give you an idea what kind of drop that would be, a test of the 200 EMA would probably take us down at this point right here. Remember, the 200 EMA is moving up every day, but that would take us down to about 11% pullback, right? So again, that's kind of what I'm looking to see here. Now, we did see this past week interest rates go lower. So if I show you this, and I just show you the 10-year interest rate on here, let me just come down to the bond market. And if we look at the 10-year, look at the rates. I mean, they just all week, they've been dropping lower and lower. And you would never, ever expect that with a higher CPI print. In the past, traditionally, when you get a higher CPI, the consumer price index, it's inflation at the consumer level, that's the first sign that the Feds are going to start talking about tightening monetary policy. They're doing just the opposite this time. And this could be a warning sign that growth in the future is being discounted, meaning we're not going to have the kind of growth that we've had before. And then eventually the interest rates is going to start going higher. Bonds are going to go lower along with the equity markets also going lower. So interest rates are going down, but who likes lower interest rates? Technology likes lower interest rates. So let me just show you a ratio chart here of technology to the SPIs. And if we look at this, you can see here since the 11th of May, right, it's been going up. So technology since 11 May has been outperforming the S&P dramatically because the line is going up. And if we come back, and let's just go back to interest rates again, right? So if we come back down to the 10-year rate right here, well, let me find it. That's not the 10-year rate. Here's the 10-year rate. Right here, you can see here, since 11 May, right here, that it was the bottom of that other chart, and it started going higher as here the interest rates have been moving down. So just put that on your sticky chart. Lower interest rates equals better XLK performance. Higher interest rates equal worse XLK performance or technology performance. And now you've got a little bit of a cheat sheet that you're going to build. And members, and I work with our members all the time to build a whole paper, just a one-page summary of what should happen when rates go down, interest rates go down, bonds go up, bonds go down. You know, what should the gold markets do? What should the dollar do? What traditionally does equity markets do? How about correlation with the volatility VIX? If you've got a positive correlation between the VIX and the equity markets, what should we expect in the equity markets? If we have a negative correlation, what should we expect? All of these little cheat sheets. If you're not a member of our group, again, you got to check it out, because if you're trading these markets, especially these markets now, it's going to be a lot harder over the next 12 months than it was on the prior 12 months. Prior 12 months through the March COVID, all you had to do is close your eyes and buy just about any kind of asset, and generally you made money, right? Unless it was an inverse ETF. But generally, just, you know, we had a list of 10 that I thought were going to go up the most, and they've done very well. But generally, anybody could make money over the past 12 months just looking at some of the equities. But right now, no, it's not like that. It's the next 12 months is going to be a lot more difficult. I guarantee you, a lot more difficult, because now money is just trying to digest these big moves that we've seen over the past couple of weeks. Okay, and that is what's created the issues here, or will create the issues on a go forward basis. All right, it's going to create some big issues. And for folks that are used to a certain kind of a market regime or a market macro environment, it's going to change. Right, and these are things, members, that we just need to understand as the regime changes. And we got some great strategies lined up. Like I said, tomorrow evening, I'm going to review one of our option masters. In our Option Masters Education Series, I'm going to add another lesson number to it, and we're going to talk about that strategy that I introduced to you a week or so ago that we're making money on. Not only in gold futures, but we're doing the same thing with Riot and others that should work out fairly well for us. Right? So imagine a strategy, guys, especially for you non-members out there. Imagine a strategy where you want to play a market that tends to just go up like a bat out of hell, but then when it goes down, you can get burned, right? Well, this strategy allows you to take advantage of the high premium by reducing downside risk to almost zero, yet if it goes higher, you can make good money on it. So those are great option strategies that you got to learn how to do. They need to be in your arsenal. So this is a little bit about what I'm seeing with technology. Okay. Now, if we come back down to these ratio charts, let's just come back down here real quick. And we take a look at financials. Okay. So look at financials here. Going back this entire week, they've been going down. Financials do not like lower interest rates. Okay. They were moving up. But now as interest rates are starting to come back down on the 10-year, financials are coming down too. So just understand that's something that just don't like. They don't want to see, right? And then let's look at the Russell value to the Russell 2000. Well, look at this. Really, since interest rates have been coming down, value has been underperforming. Why? Because with lower rates, people want to put their money in higher growth things, like in the technology sector or in the Russell. The Russell's been outperforming. It's done very well. So if you look at this, this just measures the Russell 1000 value against the Russell itself, okay? And you can see here how it's just working out fairly nicely. And if we look at, here's another interesting one to look at, is if we look at the transports against the S&P. Transports have been underperforming the S&P. So this is going to be a prescription, I think, for some pullback going back in as we go out in time. All right. Now, one other interesting comparison is Bitcoin to gold. as you can see here, Bitcoin, a lot of people thought Bitcoin was a hedged instrument. It is not, all right? It is more a speculative instrument, and you can make money in it, but you got to understand how to play it. But it's not a hedged instrument, all right? And you can see Bitcoin compared to gold has been underperforming dramatically, right? It's not working out very good. And if we look at gold to SPY, you can see, even though the spiders have been moving up, really since interest rates have been coming down, gold has been kind of coming down too. It was moving up on the idea that inflation is coming, but once it's kind of shifted its course a little bit, we're seeing gold move back down again. So relative to the S&P. So these are just some correlations that all of you guys need to know inside and out. It does not mean that those correlations are always like that. When you get a correlation that normally works out, like for example, the classic correlation is money comes out of debt and it goes into equities, or it comes out of equities and it goes into debt. That's a classic correlation. But when they run in the same direction, then you've got something going on that should not happen. And that means the markets are acting a little bit funny. And when the markets act a little bit funny, that's when you got to really watch out and be more careful. When correlations are normally set, and things are doing what they normally should do, well, then you don't have to worry as much as far as expectations of future price movement. So we're seeing that right now, all right, as I just showed you in some of these charts with lower interest rates, better performance by XLK. And if we just look at the FANG index, right, you can see here the FANG index has been slowly moving up since that low around 511, right, which is just what it's showing on the ratio chart of technology to the SPYs. So it's moved up over the 200 EMA, and it's not at its all-time high that was made back over here in end of April, but we're going to see it move up. Now, this big drop off here happened as a result of that high CPI print with interest rates going higher. In this case, it was just the opposite. So we're getting some weird data out of here. So that does tell me the market's getting a little bit nervous. We're setting up for a little bit more of a pullback in the market. So we just have to be ready for it. Okay. If we come down here and let's say we look at gold as an example. If we take a look at gold, you can see gold did have that breakout. We're in a consolidation mode in gold. Any dip in gold at this point, I would want to be a buyer of, okay? And I think it's going to run higher. In fact, my longer term price projection for gold is around the 2000 level, around 2065, 2100. I can see that with gold, okay? That would be kind of what I would expect. Same thing with silver, although silver broke out sooner than gold, and it's just been running sideways. But I do see silver coming up here somewhere in the low 30s. Okay. Now, if we do get more inflation than Boom Powell's expecting, they're going to have to be more aggressive in taking their foot off the accelerator and putting it on the brakes. That's going to create more agita in the equity markets, and that'll be more positive net long silver and gold, although we like silver better than gold. Okay. Same thing with copper. All right. And then, of course, if we come down here and look at oil, notice it's over 70 right now. In fact, on Friday, I didn't mark it, but we made new highs for 2021, right? This first run higher, I said fade the run, and then we just been in a sideways range. This run here, I don't see it having too much legs up over the 2018 high of 75.91. So I think it's going to kind of find some support here. So doing unbalanced condors, all calls in the futures market in oil, or flies, and you don't have to do large size positions, makes sense to me. I would be very leery of selling shorts underneath this unless you do it as a spread, because you can just get blown out of the water with oil. It's been fairly quiet. As you can see, these day bars, you get a movement each day a little bit higher, but it's not a big movement. So if you're running condors or you're running flies, especially of the unbalanced variety, you should be fine. Okay, I mean, it should be work out fine for you. All right, everybody, that's kind of where we're sitting for just a quick overview this weekend. Members, I will see you tomorrow night. We have a special session. I'll go through the markets in general, a little bit more detailed in this session for our round up members on the weekend. And I'll also do that special session on that really interesting option strategy that I kind of introduced to you guys a couple of weeks ago. We're running it now in my secret trader. You guys are following along. We're in profits in them, I believe, nicely, but I'm gonna amp the wattage a little bit and just kind of go a little bit more background on how you run these things and how you play them and why they're better for high vol stocks than low vol stocks. All right, everybody, have a great weekend. Members, I'll see you tomorrow night for our weekly market watch. Take care, folks. Ciao now.